Good day, accounting learners for grade 12 2022. Welcome to today's accounting lesson. My name is Paddington Zinzombe. The lesson is brought to you by the Gauteng Department of Education in collaboration with Saibono Discovery Center. And this broadcast is being brought to you by Pakama Research and Development. Today, I am bringing you financial indicators part 2. We are just going to look into these financial indicators once more. So nothing have changed from what we have been looking into on the 19th of this month. Now, today, we have got to look into the same. Let's look into the sections that we covered in the previous lesson. In the previous lesson, the first thing that we did was classifying our financial indicators. And you still remember the classes that we took our financial indicators into. We had our liquidity ratios, we had our profitability ratios, we also had our return ratios, and then we also had our solvency ratios. So that's what we looked into, the classes in which our financial indicators falls into. And then we also looked into calculations of financial indicators. We never went through all the financial indicators that I gave you, but we picked up a few of them. I still remember we looked into the earnings per share, we looked into the debt equity ratio, we looked into the return on average shareholders' equity, as well as the dividend payout rate. These are very familiar indicators when it comes to exams. So please make sure that you remember the formulas, you remember how they are calculated, because I bet you are going to be seeing the same in the exam. Today we are still going to look into exactly the same ratios and add a few of them, so that at least we can be in a position to be at par with what we expect in the exams. We also looked into the analysis and interpretation of financial indicators in our previous lesson. We looked into how to interpret solvency, liquidity, return ratios, and we also looked into our net asset value. Very important. We are still going to be looking into similar, but trying to widen our horizon so that when we face this in the exam, it's nothing new, it's something that we have done before. Today, we are going to dwell much on the calculation of financial indicators. I'm going to bring you a number of financial indicators which we are going to deal with in our today's lesson. And then we are also going to look into the analysis and interpretation of financial indicators. So you see some of the indicators after a calculation, we are going to try and comment on those indicators so that we can be in a position to see how best we comment and what is it that we are looking into when we are checking the trend in respect of these financial indicators. Now, let's get down into it straight. Let's calculate them. The first one today, we are going to look into one of the profitability ratios. This is operating expenses on sales. Check here. Operating expenses on sales. The formula is giving us plus or minus the same. Now, before I give you the formula, let me just indicate to you, boys and girls, that we are also being allowed to have an interactive session where you can send in your comments, your questions, your queries, so that we can attend to them. And our number for our WhatsApp interactive number is 082 760 2630. 082 760 2630. Back to operating expenses on sales. The first thing that you need to know is what formula are we going to use? The formula is straightforward. When it comes to this, the formula is going to be operating expenses divided by sales. But remember, our answer is supposed to be a percentage. So we are going to multiply by 100 to make it a percentage. Now, the key is you now look for operating expenses. From what we have, our operating expenses, there we are. And remember, we are calculating for the year 2022. So straight away, we have got our operating expenses at 1.9. We also look for saves. There we are, the first figure on top here, saves, 13,182,000. Now, it therefore means those are the only two figures that we are looking for from the information that is provided. Check always when you're dealing with this, they provide you with more information than required. So it is you who is going to take the information that is to be used, and then you are just going to take it into the formula given. So there we are, 1,900,000 divided by 13,182,000. When we multiply by 100, it gives us 14.4%. Very important to indicate our percentage as the unit that we are going to be having for operating expenses on saves. Now, please check here. We are looking into operating expenses. We are looking into how much or how far are we as a business succeeding in controlling our operating expenses. So if you are to look into the indicator of 2021, comparing it with the indicator for 2022, you can see that there is a decrease from 19.4% to 14.4%. What is that saying to us? Is the business controlling expenses better, or the business is failing to control its expenses? I think it's straightforward. We can say the ratio have decreased or the ratio improved because this is an improvement. We are now in a position as a business to control our expenses far better. It improved from 19.4% to 14.4%. Remember, this is accounting. You cannot just tell us it have improved or it have increased or decreased. You need to give us figures for us to be in a position to say this is an acceptable response. So we are looking into figures. Support your answers with figures. So we can safely say expenses are better controlled in 2022 compared to 2021. Expenses are better controlled in the current year compared to the previous year. A very good thing, a positive trend. Now we move on to the next indicator. This one is the familiar one. We have been looking into this indicator since grade 8, markup. So I know you know the formula for markup. The formula for markup, it's simply gross profit divided by cost of sales. But remember, it's supposed to be a percentage. So we are going to multiply by 100 to make it a percentage. So what are we doing here? We are checking how much is our gross profit. There we are, 4,852,000. And then how much is our cost of sales? Here we are, 8,330,000. So very important to be in a position to identify the figures that are required in our formula. Because what we are just doing is to take the figures into the formula and life becomes very good for us. So we are going to take these two figures into our calculation. 4,852,000 divided by 8,330,000. We multiply this by 100 and it's going to give us our markup of 58.2%. Now, what it therefore means is there is something that is being indicated. We had a markup of 72% in 2021, and now we are having a markup of 58.2% in 2022. The business reduced the markup. So we can safely say the markup has been reduced from 72% to 58.2%. What is the effect of reducing our markup on business? It means we are going to be in a position to get additional profits which are less than previously. But remember, when we are reducing our markup, if the costs remain the same, we are going to be selling our products at a price that is far less than previously. And then when that happens, you know, what are the effects? People, our customers, are always interested in cheaper commodities. Now, we want to look into a comment that we can say with regard to the effect of this markup on what happened. So if you can check, there's a follow-up question which says, comment on the decision that has been made by the business regarding the markup and how it affected business. So let's look into our information. Key items that I want you to look into are sales. What happened to our sales? They increased from 7,740,000 to 13,182,000. Check that. Increase in sales. Is that a good thing? Is it a bad thing for business? Now, let's look into the number of bikes that have been sold. It increased from 900 bikes to 1,750 bikes. That's nearly double the number of bikes that have been sold. Is that a good thing? Or it is a bad thing for business? Now, I also want you to look into what happened to our gross profit. Though there was a reduction in markup, our gross profit increased from 3,240,000 to 4,852,000. Let's recap. The business made a decision to reduce markup. Comment on whether this decision has benefited the business or it made the business far worse. I think, guys, you can see for yourself. The information in front of you, the figures in front of you are saying it all. So we can look into the comment as in the reduction in the markup has resulted in increase in the number of bikes that have been sold. You can see it. Nearly double as we have already agreed to. And then we can also look into the increase in sales. Sales increased from 7,740,000 to 13,182,000. That's a good thing. You can even add an increase in gross profit, which was a result of a decrease in markup. So please remember, it doesn't mean every time when we are increasing our markup, we are doing something better for the business. Sometimes a reduction in markup can benefit the business, like in this case. We have got nothing to wait for. Let's move and look into another class of indicators. This time we are looking into our liquidity indicators, starting with the acid test ratio. So the question is requiring us to calculate the acid test ratio, and we are given information that is in front of us. Please take note. Not all information provided to us is going to be used to deal with the question on hand. So remember, we need the formula. What is the formula for acid test ratio going to say to us? Remember, the formula is our current assets minus inventories. And then we compare this to our current liabilities. Current assets less inventories as to current liabilities. So what is that going to say? we need to identify first current assets. Let's check. There we are. Our figure for current assets is given. What else do we need to identify? Inventories. There we are. Our figure for inventories given. We also need current liabilities. Our figure for current liabilities given. Please check. All these figures are coming from our balance sheet. And I still remember you guys, you went through the balance sheet and you understand it so well. You know what to find under current assets and what to find under current liabilities. Now, what do we do first? Let's deal with our left-hand side. Current assets minus inventories. So we are just going to take our 2,273,400, which is current assets. And then we subtract 942,200, which is our inventories. And the result, the net current assets is 1,331,200. Please take note, that is going to be our left-hand side. Now, on the right-hand side, we already have our current assets. So it is going to look like this in the ratio. 1,331,200 divided by, S2, 1,024,000. Now, remember, our right-hand side will always be 1. So it means we are going to divide 1,331,200 divided by 1,024,000 so that we can find the indicator that is going to be on the left-hand side. So you can see when simplified, it becomes 1.3 S to 1. Remember, we also need to look into what is this saying to us. So if you check here, the asset test ratio in the year 2020 was 0.7 S to 1. And then into 2021, it means it's going to be 1.3 S to 1. What is this information saying to us? We are simply saying in 2020, our current assets were not in a position to pay off our current liabilities without us going on to sell our stock. So it means for us to be able to pay off our current liabilities in 2020, we needed to get into the storeroom, take out stock, and then sell it so that we can be able to pay off our current liabilities. Is that a good thing? Now, let's flip to 2021. It means now we are having 1 rand 30 for every 1 rand that we are owing. We can be able to have 1 rand 30 for every 1 rand that we are owing of our current assets without even getting to our stock. Now this, I think, is a good position for the business. Without selling our stock, we can still be able to pay off all our current liabilities. Now, please look into how can we comment on this change. We can simply say the ratio, or our asset test ratio, had improved from 0.7 S to 1 to 1.3 S to 1. But we can also indicate that the business is in a better liquidity state because it can settle short-term dates without relying on the sale of our inventory. The business can settle its short-term obligations without resorting to selling the inventory. Remember, it's not easy to just sell our inventory. We can also indicate to say this ratio is good because it's at 1.3 S to 1. If that ratio was at 2 S to 1 or at 3 S to 1, we were going to say, no, this is not good. Why? Because it was going to indicate that cash is idling. And remember, it's one of the assets that should not sleep. It should be out there making money for us. So when we have a higher ratio, 2:1, 3:1, it will indicate that cash is idling rather than being invested to generate income for the business. Very important to note. Now let's move on and look into the next ratio. Dividends per share. In this case, we are looking at the interim dividend per share. Very important. Interim dividend per share. Now we are given information on dividends, returns, and shareholding for the 2022 financial year. And it says here, when the year started on 1 March 2021, there were 800,000 shares in issue. And then on 31 August 2021, interim dividends were paid. Very interesting. They are not telling us how much per share, but they are telling us how many shares were issued and how many shares are we issuing this, are we giving this interim dividends to. Important information, but incomplete, and it's not going to be able to help us unless we get some additional information. So let's see if there is any other information at our disposal. Yes, I like this. Now this was taken from the cash flow statement, and it's indicating from our operating activities that we have paid dividends, 520,000 in 2022. Guys, boys and girls, do you still remember how do we come up with this figure? We can prepare our dividend paid notes, but another easy way is just to say it is made up of the final from the previous year. I call it the final last year plus the interim current year. Yes, it is made up of our final dividend from last year plus our interim dividend during the current year. And then, so it means we are given this 520. If someone is going to give us the final dividend of last year, it means we can find our interim dividend. It means also if someone gives us our interim dividend, we can find the final dividend of last year. So let's see if they are giving us any additional information. There we are. Bingo. We are given an extract from our balance sheet. Shareholders for dividends. You still remember this item under our current liabilities. Shareholders for dividends. What does shareholders for dividends indicate? The final dividend. So the final dividend last year, which is in 2021, was 280. And the final dividend in the current year is 750. But we are much interested in the final dividend of last year because it is going to help us to find our interim dividend. How do we go about it? The total paid, which is our 520,000 minus the final of last year, which is 280,000. It gives us 240,000. So it simply means we are paying 240,000 as dividends to shareholders who are owning 800,000 shares. We can easily now use this information to find the dividend per share, the interim dividend per share. 240,000, which is the interim dividend, divided by the number of issued shares that we are issuing these dividends to, and our answer is going to be 30 cents per share. So it means during our interim period, we were giving dividends which are 30 cents per share. 30 cents times 800,000, that's how we got to our 240,000. Now I can see you guys doing this better than anyone else can ever do going forward. Now, the next thing that we are going to look into is the total dividends per share. The total dividends per share now, the total dividends per share. Remember, we only have got our interim per share, which is 30 cents. Now, let's see what other information are we given. We have already looked into the first two items. So let's go to bulletin number 3. On 1 September 2021, 200,000 shares were issued to existing shareholders. So 800,000 shares were there issued at the beginning of the period. And then during the year, we issued another 200,000 shares. And then I'm thinking, how many shares are in issue as we are on the 1st of September now? Okay, food for thought. On 28 February, the final dividends of 25 cents per share were declared on all shares, but have not yet been paid. I think we are familiar with that. The final dividend always declared but not paid until the following year, because usually it's declared at the end of the current financial year. So we want to find our total dividends. Now, remember what we are having here. We are given the interim dividend. We still remember we calculated it. In fact, we got it. We even found the interim dividends per share. And then we are also given the final dividend, which is simply going to be 75 cents per share. So we need to know how many shares are in issue now. Remember the 800 that we had when we started the year, plus the 200,000 that was issued on 1 September. So we are now having 1 million shares in issue. So to find the dividends, it's simply 750,000, which is the final dividend. There, highlighted here. And then we divide by 1 million shares, so it's 75 cents per share. And please take this information we already have. And then for the total dividends now, it's simply going to be 30 cents interim dividend plus 75 cents final dividend, which gives us 105 cents per share, which is 1 rand 5 cents per share. Total dividends per share. Please take note. We are going to be having this in cents. That's the reason why in that formula there is always times 100, because we are supposed to remember there is always 100 cents in a rand. There are 100 cents in a rand. Now let's look into the information now as we are given. Now let's assume there was a need for us to comment on this. What are we going to say? The dividends per share increased from 70 cents per share in 2021 to 105 cents per share in 2022. Now, we can just find the difference between the two figures and say the dividends per share have increased by 35 cents, which is still correct. Now, let's also look into now the earnings. How do we go about commenting on the earnings per share? Now, remember, we can calculate the earnings per share. How do we calculate the earnings per share now? It is going to be net profit after tax. We divide by the number of issued shares. So what is our net profit after tax? There we are, net profit after tax. There you are. the number of issued shares. Remember, 200,000 that was added onto what we had from the start of the year. And we got our 1 million ordinary shares that have been issued now. So when we divide this, it's going to give us 190 cents. Remember, this is in cents. And remember, we are multiplying by 100 because we want our answer to be in cents. Now, it therefore means now when we have got our earnings per share, let's comment and look into what happened to our earnings per share. They've increased from 130 to 170. Or you can simply say they increased by 60 cents, which is still making sense. Now, the next item that we can see, which the examiners are falling in love with, it's the dividend payout rate. Very important. In other words, what is the dividend payout rate saying? It is saying, out of the net profit after tax, how much are we giving to dividends? There are a number of scenarios here. The business can decide to give half of that to shareholders as dividends. So we are going to say the payout rate is 50%. Now, the business may decide to give more of that to shareholders. So maybe they can give 90%. So in other words, we are saying the business is giving 90% to the shareholders, 90% of the earnings. What does that mean now? If the business is giving 90% of the earnings to the shareholders, the business is only retaining the remaining 10%. Is that a very good thing to do? Is that a very clever way to do things in business? What might be the problems to that? Okay, think about it because we are definitely going to look into it. But sometimes we can also have a business which can decide to give only 20% to the shareholders as dividends. What does that mean? It means the business is going to retain the 80% that remains. Why would a business choose to retain much of the profits? Why might a business choose to give only a fraction of the profits to shareholders and remain with the rest? Think about it, boys and girls. Food for thought, because it's going to be very important in answering the comment part. Now, let's go back to the calculation part. Now, in this case, now we need to remember the formula. Now, this is one of the indicators which have got two formulas. So we can try formula number 1 and still try formula number 2 to get to the same answer. All information that you are going to be given in the exam is going to allow you only to use one of the formula. Please be familiar with the formulas that we are going to be using here. Now, the first formula says dividends for the year, which is total dividends for the year. And remember, total dividends, it's a result of the interim dividend plus the final dividend. Dividends for the year divided by net profit after tax. Remember, net profit after tax is our earnings. That's what we have earned as a business. And then we multiply by 100 because we want our answer to be a percentage. But there is another formula that we can use. We can use dividends per share, which means we are going to look for the refined dividends per share figure, like this one, 105 cents. And we divide it by earnings per share. This is your earnings per share, 190. And then we multiply by 100 because we still need to have our answer as a percentage. Now let's deal with the first one first. For this one to work, we need to remember the final dividend. Remember, the final dividend was 75 cents per share, and we had issued 1 million shares, so it gave us 750,000. And then we also need to look into the total dividends. For the total dividends, it means final dividends plus interim dividends. Remember our interim dividends, that figure, 240,000. So we add them together. It means our total dividends is an amount of 990,000. Now, it therefore means we have got a figure that we are going to take into the formula. But remember, the other figure that is required is net profit after tax. Our formula needs those two figures. So let's put them into the formula and solve it and see what we get. So it's going to be simple, guys. 990,000 divided by 1,900,000. We multiply by 100 over 1 because we want it as a percentage. And my calculator gave me 52.1%. Let's hope yours gives you the same. Now, let's check. Let's use the other method because we never know. The examiners might give us only information that allows us to use. But today we are lucky because we have got all the information at our disposal. Now, this is the alternative calculation, dividends per share divided by earnings per share. Our earnings per share, we have identified it. Our dividends per share, remember, we now have it. These are figures that we calculated in our previous calculations. Now it is going to be the interim dividends divided by, it is going to give us our total dividends as indicated, and then the payout rate is 105, which is the dividends per share divided by 190, which is the earnings per share. And when you multiply by 100, my calculator is giving me another 55.2%. You can see the margin of error is very little, very limited. That is the calculations on the dividend payout rate. I will never be able to overemphasize the need for you to be in a position to calculate the dividend payout rate because I foresee us having it in the exam. Not to say this is the most important ratio. All the financial indicators we are giving to you, very important. You need to know how to calculate them so that when we get into the exam, we are going to be on top of our game. I'm just going to give you a breather of 2 minutes so that you can be in a position to drink a little bit of water, check your surroundings, so that we can be in a position to get back to business in our next segment. Thank you. Thank you. Hope you had a very nice breather then. Now let's keep on our financial indicators. I do have a calculations for the other 4 coming financial indicators. Let's go through them and then we see how much we are going to benefit from this. Now this is saying Taylor Limited. The following information pertains to the financial records of Taylor Limited for the year ended 28 February 2022. We are supposed to calculate the following financial indicators on 28 February. So it means we are much interested in the information at the end of the year 2022, financial year ending on 28 February 2022. The first one, the net asset value per share. Net asset value per share. This is the information that we are given here. We are always given more information than we are going to require, right? So always be in a position to at least extract the correct formula so that you extract the correct information that you are going to feed into your formula and life is going to be easy on you. So this is the scaled down information on which we are going to make this calculation. Now, what is the formula? Shareholders' equity divided by the number of issued shares. Please check this. I have seen a number of candidates having a problem in this ratio because when it comes to this indicator, it's saying net asset, but the formula is saying shareholders' equity. Please remember this. Your net assets equals shareholders' equity. How do we find our shareholders' equity? Remember, it is going to be assets, total assets, minus our liabilities. And how do we find our net assets? Still the same thing. Assets minus liabilities. So it therefore means what? It simply means our shareholders' equity is equal to our net assets. These are the same. So in the formula for calculating net asset value per share, we are going to say shareholders' equity divided by the number of issued shares. Now that we have got the formula, which is correct, we are going to check shareholders' equity. Which figure is that? 1,690,000. And then we need the number of issued shares at the end of February 2022. It's 762,000 shares. Let's take this information into our formula. You know, when you've got the correct information, the correct formula, everything else to be done becomes painless. So it's 1,690,000 divided by 762,000, which is the number of issued shares. And then this is going to give us 221 cents. So it means the net asset value per share is 221 cents. For 3 marks, not bad at all. Let's look into the next indicator. The return on shareholders' equity. The return on shareholders' equity. Now, remember the formula. Net profit after tax. We divide it by the average shareholders' equity. Remember, when they say average, when we are looking into financial indicators, it means we are supposed to find the opening balance and the closing balance, add the two together and divide by 2. That's the simple way of doing it. Find the opening balance, closing balance, add the 2, and then you divide by 2. That's how you get your average. So what are we having here? Net profit after tax. Is it given? Yes, I think I can see it. There it is. So we are given that one. And then we also need what? Average shareholders' equity. But this is going to be when we look into these two figures added together and dividing this by 2. So the minute you get to average shareholders' equity, remember we have got those two figures that needs to be added together and we divide by 2 to find the average shareholders' equity. Let's take this into our formula. There it is. 457,200 net profit after tax. We divide by half of our 1,510,000, which is the balance at the beginning, plus 1,690,000, which is the balance at the end. Remember here we want to have our answer as a percentage, so because of that, we multiply by 100. I would want to emphasize here, you need to know what is the unit that you would want to have at the end. Because multiplying by 100, it doesn't mean it's percentage all the time. Sometimes we are multiplying by 100 because we want our answer to be in cents, because there are 100 cents in a rand. And then sometimes we are multiplying by 100 because we want our answer to be a percentage. So always remember, it's not always multiplying by 100 to get the answer as a percentage. And then check what is the answer for us here. 25.8%. So that is the return on average shareholders' equity, ROSHER. Closely linked to this, we have got the return on average capital employed, and return on total capital employed. Now, what is the difference between shareholders' equity and capital employed? Because that's the key. If you miss that, then you are going to be in trouble. Now, when we are talking of capital employed, we are saying, where are we sourcing our money from? So that we can use this money in our business. We can employ it now into the business. So where are we getting our funds from? Let's go to the cash flow statement. I'm not saying we are opening a cash flow statement, but please remember what we say under financing activities. Who is financing our business? Shareholders. So that's the reason why we are going to have proceeds from issue of shares. And that's why we also have got to discuss buyback of shares. We are getting our finance from our shareholders. Where else? We are borrowing money in terms of loans. So that becomes our capital employed. What does that mean now? It means we are going to have two elements as our numerator. It is going to be profit before tax, not after tax this time. Profit before tax plus interest expense, which is interest on loan. So let's check our numerator. We need net income before tax. There we are. Not net profit after tax, guys. Net profit before tax. And we also need interest on loan. There we are. So that is going to make up our numerator. But when it comes to the bottom line, the denominator, it is average capital employed. And I said capital employed, you've got something to do with share capital and the loans. So we are going to have 4 figures added together there. Opening shareholders' equity plus closing shareholders' equity. We are also going to have opening loan figure or loan balance plus closing loan balance. We add them together and then we divide by 2, because 2 of those figures are representing the beginning of the year and 2 of those figures are representing the end of the year. We divide by 2 so that we can find the denominator part. So let's see how is it going to look like. 635,000 plus 84,000, the numerator part. We are going to divide by half of 1,510,000, which is the opening shareholders' equity, plus 1,690,000, which is the closing shareholders' equity, plus 600,000, which is the closing loan balance, and 453,000, which is the opening loan balance. Added together, we are going to find half of that, which means we are dividing it by 2, and then we multiply by 100 because this has to be as a percentage. So this fits on your calculator. If you try it, this fits on your calculator, and when you calculate, you are going to get the answer of 33.8%. If you are still struggling with the use of a calculator, please make sure that you indicate or you practice with your calculator that you are going to use in the exam. Indicate your difficulty to your teacher so that at least you are given faster ways of calculating figures. Getting into that exam, you need to be at your peak. Now, we are going to look into the last indicator on this segment, which is our debt equity ratio. We are going to look into our debt equity ratio. Now we are given all this information. It doesn't mean we are going to use all of it. Remember the formula. Debt equity ratio. What is the formula that we are going to use? Non-current liabilities. Remember your debt, it's your long-term liabilities. Your debt, it's your non-current liabilities. As to shareholders' equity. Non-current liabilities as to shareholders' equity. Very important for you to be in a position to remember this. Now, we are going to check, do we have the figure that represents our non-current liabilities? There we are, long-term loan, that's our non-current liabilities, 600,000. And then we also have a figure representing our shareholders' equity, 1,690,000. That is your shareholders' equity. Now we take this information into the formula so that we make life very easy for ourselves. So it is going to be 600,000 as to 1,690,000. Remember what I said, your right-hand side is always going to be your 1, which means we are going to say 600,000 divided by 1,690,000. And you can see when we calculate now, it's going to give us 0.36 on the left-hand side. So it therefore means it is going to be 0.36 as to 1. And this is our debt equity ratio. Now, this is where we are going to end with the segment on the calculation of financial indicators for the day. The next part that is coming, we are going to be busy with commenting on financial indicators that are given to us. We want to make sense out of financial indicators. Can we communicate using our financial indicators? Can we decide using our financial indicators? Today, it's your very good and lucky day. You are going to have a 5 minutes break. And then at the end of the 5 minutes break, we are going to be looking into these financial indicators discussions, commenting on the financial indicators for the good of our business. See you after the break. Welcome back. We are still at it. Financial indicators part 2. Now, what we are now going to look into is commenting given financial indicators. Unlike last time when we were just looking into financial indicators for 2 years, today I brought you financial indicators for 2 different companies and we are comparing. And usually we say for comparing, we need to find 2 businesses that are in the same industry so that we cannot have a lot of variances as a result of not doing the same thing. Now, the information provided says financial indicators of 2 companies. Your friend is an existing shareholder in 2 companies that sell books. So they are in the same business. He presents you with information of both companies. The first thing that you are required to do is, your friend is of the opinion that the liquidity position of Westlands Limited is better than of Northwood Limited. Quote 2 financial indicators, remember always with figures, to support her opinion. Let's see if your friend have got enough financial knowledge as you have so that you can be able to advise. So the friend is saying the liquidity position of Westland is better than that of Northwood Limited. There we are, Northwood Limited, Westland Limited. These are their financial indicators. Now, the first thing that should come to your mind is, do you remember the liquidity indicators? Because in this question, you can see we only gave you 4 indicators, but you are going to get into the exam where you are given 15 or 20 indicators. Now, out of those, you are supposed to take out the required number of indicators. So what we are doing here, we are going to need 2 liquidity indicators. Can you be able to name any 2 from the information that is presented to you here? Let's see. I can see what you said. Current ratio, correct. Yes. Acid test ratio, that's good. Stock turnover rate, you are still okay. But if you say debt equity ratio, then you are not right. So the first 3 are our liquidity indicators. So the first thing is to identify ratios that are required for us to be in a position to comment on whatever we are expected to comment on. Now let's look into the current ratio. Westland 2.4:1, 3.6:1. And then acid test ratio 1.2:1 for Westland and 0.6:1 for Northwood Limited. Stock turnover rate, Westland 8 times, Northwood 4 times. Let's see which one of the 2 companies is having the best of indicators here. I still remember someone who asked me the same thing as you are going to ask me now. Why can we say Westland Limited is having a better current ratio than Northwood Limited? Let's just look into something here. The relationship between current assets and acid test ratio. What separates the 2? Inventories. So in short, what does that mean? When we take the 2.4 for Westland and we subtract the 1.2 I mean the 2.4 in the current ratio, and we subtract the 1.2 in the acid test ratio, we are going to remain with 1.2. That 1.2 represents what? Inventories. Okay, let's go to Northwood Limited. 3.6 in the current ratio minus 0.6 in the acid test ratio. 3, it's representing what? Our inventories. So it means when we get to Northwood Limited, most of our current assets are made up of inventories. And you must know what it means. We are holding too much inventories in the business. 1, inventories is not as liquid as other types of current assets. We cannot force people to buy inventories, so we cannot easily convert inventories to cash. 1, keeping too much stock is a disadvantage for business. It can become outdated whilst it's in our hands. Not good. Too much inventories is not good for business because it means we are going to pay a lot of costs for keeping that inventories. We need bigger room for inventories. We need security for inventories. We also need insurance for that inventory. So there are a number of elements at play when it comes to this. But anyway, how can we use this information at our disposal to answer the questions that we are having? One thing that is very important, if you are to compare, we need you to give us the indicators for both companies. You cannot just comment on Westland because they say it's the better one. No, you need to comment on both. So the current ratio of Northwood Limited is 3.6:1. And that one of Westland Limited is 2.4:1. Never say the examiner knows, so he will check. No, it's your duty to check and inform the examiner of what you are seeing. Then you can comment using the acid test ratio and say the acid test ratio for Northwood is 0.6:1 and for Westland Limited is 1.2:1. Now, when it comes to the acid test ratio on its own, it means Westland Limited cannot be able to pay off its current liabilities without tapping into its inventories, without selling inventories. And then we go to the stock turnover rate. For Northwood, it's 4 times. And for Westland Limited is 8 times. The faster we turn over our stock, the better we are as a business. So what is it saying? It is saying Westland Limited is selling or is turning over its stock faster than Northwood Limited. Now, what explanation can we be giving in these instances? Now, Westland Limited has a better current ratio and is able to cover its liabilities, whereas Northwood Limited's ratio is too high. It means funds are tied up in stock, which is part of the current assets. So it means now when we are tying up funds in stock, we are not using our funds profitably because stock, it is going to be rigid in our storerooms, but if we had cash, it was going to be running around earning something for the business. Now, when it gets to the acid test ratio, we can safely say Westland Limited has a better acid test ratio than Northwood Limited. Northwood Limited has too much stock on hand, which resulted in the poor acid test ratio. You still remember what I did with the calculations of the difference between the two. And we say the 3 in Northwood Limited is representing stock, but in Westland it's only 1.2, which means we are having a better deal with stock in Westland Limited than in Northwood Limited. Also, we can say Westland Limited is selling its stock faster. That is 8 times during the year as compared to Northwood Limited at 4 times. So it therefore means you can see all the scales are tilted towards Westland Limited as the better of the two companies. So we can safely say your friend have got good accounting or financial indicators and knowledge to be in a position to make a decision. Very important. 1, to identify the financial indicators to be involved. 2, to know what are they saying given that information. Now let's move on to the next one. It says here, the question, will the shareholders be satisfied with the price at which the new shares were issued in both companies? I think there is, right. In this case, we were looking into how far is the risk in this company, right? And we are using the 2 indicators when we are looking at the degree of risk, which are the debt equity ratio and the return on total capital employed. Now, please check something for me here. When it comes to debt equity ratio, it is always 0.1:1, going up maybe to 0.3:1, and then it goes maybe up to 0.9:1. Now, when it is here, it is high geared. It means the business is relying more on borrowed capital, which is not very good. But when it is towards the bottom line, 0.1, 0.2, 0.3, it means the business is low geared. It means they are not relying too much on the loans. So when we are looking into the decision either to repay a loan or to borrow, when do we borrow? When we are low geared, it means we are not relying too much on loans. We can still go on and borrow. When do we have to make a decision to repay? When we are high geared, it means we are relying too much on loans and it's not safe. Let's repay the loans. Now, but when you comment on risk, please also remember to bring in the return on total capital employed. Now, the return on total capital employed, you are going to see that it is looking into the return that the business is having after employing capital. And capital is made up of shareholders' equity and the loan that they borrowed. So let's look into what's happening here. When we look into the debt equity ratio, we can safely say the company is at low risk. Therefore, there is no need to pay a large portion of the loan. We are low geared, low risk. Why should we bother and pay? Unless maybe when the risk is high. Let's check into return on total capital employed. The return on total capital employed is 18.4%. But please take note on this one. We need to always compare this to the interest on loan. Now, what is the interest on loan? The interest on loan in this case is 10%, 10.5%. Now, interest on loan is the cost of borrowing. I always use this example. There is a friend of mine who is looking for 100 Rand fast. And then I'm taking my chance. I say, okay, I can give you 100 Rand right now, but I need it with interest tomorrow. So you are going to give me 150 tomorrow. I, my friend, accepts. But I don't have the 100 Rand. So I start running around to borrow this 100 Rand. Now, if I get to someone who says, I can get this 100 Rand at 20% interest, it means I must bring back 120 tomorrow. Then I can take that money, give to my friend, get 150 tomorrow, and then I've made money. But if I can't find someone who is willing to borrow it to me at a lower interest rate, why should I bother? It's not going to make sense. So it means we are borrowing at 10.5%, using that money to make 18.4%. Is that a clever business decision? The answer is simply yes. We are making money out of this. So always when you are commenting on risk, on the return on total capital employed, remember to bring in interest on capital, because we are saying you are borrowing at this rate and you are making this rate. If ever we are going to have the return which is lower than the 10.5%, then borrowing is no longer an option, because you cannot borrow at a higher rate than the rate that you are going to get as your returns. Hope it makes sense. Now, will the shareholders be satisfied with the price at which the new shares were issued for both companies? Explain. Now, there is something that is happening here. The companies have decided to issue shares, and then they are issuing these shares. This one it's issuing at 260 cents. This one it's issuing at 280 cents. Is it making sense? I'm wondering. Now, what is it that we check? Please check. We are going to be using these indicators. The market price per share on the JSE. What does this signify? It signifies how much investors are willing to pay for these shares. So what are they investors willing to pay? They are willing to pay 7 Rand 10 for Northwood shares and 9 Rand 10 for Westland Limited. And then we also need to check the net asset value per share. How much is the value? The value of the asset that the share is contributed into the company. So in this case, the net asset value is 5 Rand 35 for Northwood and 11 Rand 20 for Westland Limited. Now, how much are we expected to be charging for these shares? So our price should be somewhere nearer to what people investors are willing and able to pay for those shares, which is around 7 Rand 10 as well as 9 Rand 10, because that's what we are looking into as what investors are willing to part with in order to acquire these shares. But now, from what we can see now, where both companies have issued 189,000 shares at the end of the current financial year, now let's look into in which company is there sense. Now, when we go to Northwood Limited, there is a problem there. Now, these ones, they sold shares at 2 Rand 60 cents under the market value. There's no need for you to be in a position to be selling shares at a price lower than the market value. And check here, how many cents under the market value? 260 cents under the market value. Now, the selling price is also 85 cents less than the net asset value. So when we check with the net asset value, we are not winning. When we check with the market price per share, we are not doing the right thing. So in other words, we are disadvantaging the existing shareholders. They are losing money. In this case, because it's 2 Rand 60 below, it means when you multiply by the 189 shares that have been issued, it means they have lost 491,000 shares. What would have been a solution to this? They could have raised more money if they have increased the price. They should have issued these shares at the market price, or maybe at any other price nearer there, so that they wouldn't lose money. But let's check what happened with Westland Limited. Now, they sold these shares at above the market price. Oh, they are clever, these guys. It means now they are gaining more. Though people or though investors are willing to pay so much on the market at the stock exchange. They are being in a position to sell to other willing stakeholders or investors at a price above. Now, the selling price is also 80 cents more than the net asset value. What does that mean? It means the existing shareholders in this case are gaining, and they are gaining 529,200. They couldn't have done it in any better way. Now, let's look into these other indicators now. They're saying here, your friend owns 30,000 shares in each company. Calculate the dividends that he earned from each company. Straightforward, simple. So if someone is earning 30,000 shares and we need to know how much is the dividend per share. For Northwood, R2.30. For Westland, R2.45. So we can calculate the amount or the total dividends earned by this friend of ours in both companies. Starting with Northwood, 30,000 times R2.30, it gives us 69,000. Straightforward. Westland Limited, 30,000 times R2.45, 73,500. I think when you get something like this, then straightforward, you don't need to sweat. Remember only that dividends per share, we are looking at how much each share it's issuing, it's gaining as dividends. So it means R2.30 times the number of shares that he owns, and then we are going to be finding how much our friend is getting in both companies. And then it says, compare and comment on the dividend payout policies of the two companies. Provide calculations in your explanation. There we are, two companies, and they're saying here we are supposed to compare the dividend payout policies. Now, where are we? We are here. We are comparing earnings versus what? Dividends per share. So let's look into Northwood. They earned R350, right? Which is 350 cents. And out of that, they are giving out R2.30 as dividend. Can you see that? So it therefore means now they are going to retain something like 120 cents retained. It means they are not issuing out that. But let's look into Westland Limited. They earned R2.85. And out of that, they are giving away R2.45. What does that mean? It means they are only retaining the difference between the two, which is 40 cents. Retaining 40 cents, retaining 120 cents. Which is better? You still remember I gave you that as food for thought to say, when a company is retaining more, why? Or a company is retaining too little, why? Now, it goes down to say, these ones, Northwood Limited, they are distributing 66%, which means they are going to retain 34% of their dividends. Their earnings as retained income. Now, they are distributing 66%. And how did we get 66%, by the way? Dividends per share divided by earnings per share multiplied by 100 payout rate. 230 divided by 350, we multiply by 100, and we are getting 66%. That's the payout rate. Now let's go to Westland. When we get to Westland now, it's 245 divided by 285, and then we multiply by 100, and it's giving us 86%. It means they are giving away 86% of the earnings. And how much are they retaining? 14%. Two companies. The other one is retaining about 34% of their earnings. The other one is retaining only 14% of their earnings. Why? can two companies do something like this? Please take note of this. When we have got a company that is looking into the future and they are thinking of future expansion, they can only expand if they have got funds available, and they can do that by retaining most of the profits that they have earned, and they can use it for future expansion. But at the same time, remember, sometimes there is something that the investors know about the company, and there's something that the directors and the people within the company wants to communicate to shareholders. So if they want to make the shareholders happy, or they want to make sure that the shareholders believe that everything in the business is okay, they can do that by giving them too much dividends. They give them more dividends. Sometimes they can even give them more dividends than what they have earned during the current year. So they are going to use the retained profits from previous years in order to just make their shareholders happy. So it depends on what is it that the directors of the company wishes to communicate or wishes to imply to the shareholders. Now, we go to the last part now. It says, explain one reason for the dividend payout of each company. Now, starting with Northwood, remember what we said. They are retaining about 34% and they are giving away 66%. These ones, they are retaining 14%. They are giving 86%. So why is this one retaining more? I think I've said it. Maybe they are looking into the future and they know the future needs them to expand, which means they need funds, and they are not going to be going back to the shareholders to issue shares to raise funds, but they can just use the profits that they've retained and expand into the future. And then why are these ones giving more to dividends? Maybe they have expanded enough and this is the time to try and make their shareholders happy. So out of all the monies that they are getting as profit, they pass it on to their shareholders as dividends. Now, these are expected responses that we can have. Now, Northwood Limited appears to have plans for growth, which is better long-term benefits. So in that way, they are trying to reduce dividends that they are giving to shareholders so that they can have more retained income for the future. Western Limited appears to keep shareholders satisfied by giving them good dividends. Now, what does that mean? It means now they want to make sure that their shareholders are happy. And how do you make shareholders happy? Give them as much dividends as you can as a company. Please take note, time is getting to the end, but let's just do a rundown here. What are we expected to do given this topic? Know your formulas. Know how to substitute into the formulas. Know exactly which figure I need to place where in the formulas for me to be in a position to have a proper calculation of the said financial indicators. Also know the relationship between indicators and the information that the indicators are communicating, either to shareholders, to management, to any other stakeholder in the company. And when you know this, you can be in a position to perform well in this section of your syllabus. We are going to be meeting again in future segments where we are going to be looking into other topics to help you to do well at the end of this year. Remember, we are still in COVID period. Mask up, sanitize, keep yourself clean, social distance, so that we get out of this with our life. Thank you.